Hey guys, it is Julie here with TipRanks, and today we're taking a look at 3 stocks for both dividends and growth. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. I hope your week is off to a great start. Now I know a lot of you are big fans of dividends, so today I thought we'd use the TipRanks stock screener to find some stocks that not only pay an attractive dividend yield, but analysts think have some great growth potential for the future as well. So we're going to do just that. We'll take a look at these companies, what it is that analysts are predicting for their stock's future, and of course some details around those dividends. Don't forget you can check out the TipRanks stock screener for yourself over on the website, and also download the TipRanks mobile app so you can stay up to date with all the latest analyst ratings. Links will be in the description down below. Now let's get right into these 3 dividend growth stocks. First up, we have Philip Morris. Their stock trades under the ticker PM, currently priced at $97 per share. Now they are fairly flat this past year. They saw some big growth going into 2023, but cooled off a bit since then, but have been on the rise the last few months, up over 5%. Philip Morris is a leader in the global tobacco industry. They own the right to produce and market the iconic Marlboro brand cigarettes outside the United States, and among their other brand names are Next, Chesterfield, L&M, and of course Philip Morris. The company can boast a first or second place market share position in most of the 175 markets where their products are sold, and that global market is huge, valued at $867 billion last year and expected to reach over $1 trillion by 2030. Of course, trends have been changing in the tobacco industry, and Philip Morris has been planning for a future of reduced tobacco consumption. In recent years, they've invested more than $10.5 billion into a line of smokeless tobacco products. In 2021, 29% of their total net revenues came from their smoke-free products. By 2025, their target is to increase that figure to at least 50%, with the ultimate goal of phasing out cigarettes completely. Philip Morris has been increasing their annual dividend every single year since they went public back in 2008. Their current quarterly dividend is $1.27 per share for a dividend yield of 5.25%, well ahead the sector average of just above 2%, and the next payment date is coming up on July 11th. And on July 20th, we'll be hearing the company's Q2 earnings report, where analysts are anticipating earnings per share of $1.50. In their Q1 report, the company reported earnings of $1.38 per share, coming in 4 cents ahead of analysts' expectations, and revenue of $8.01 billion. They saw their adjusted net revenues increase by 3.2% in organic terms against a very strong prior year quarter that had increased by 9% on the same basis. Their stock currently has 11 analyst ratings, coming in as a strong buy based on 10 buy ratings and 1 hold. Analysts' average price target comes in at $115, which would be an upside potential of 19% from current prices, and we can see a pretty tightly grouped range of price targets here. Down below, we can see all of our recent ratings, including one from 6 days ago from Citigroup. They gave it a buy with an upside of 21%, saying that investors are undervaluing the growth of smoke-free products. Many of the analysts coming in with that 13 to 24% range. Second on our list, we have a company with a similar sounding name but very different business, with Phillips 66. Their stock trades under the ticker PSX, currently priced just above $91 per share. Their stock has seen growth of 9% overall this past year, but has tapered off a bit in the last few months and is down 4%. Phillips 66 is one of the world's major oil companies. Phillips generates their revenues by bringing crude oil, natural gas, and natural gas products, mainly liquids, to the refineries, and then marketing a wide range of refined hydrocarbon products, including automotive and fuels, fuel and lubricating oils, petrochemicals, and other industrial chemicals. The company currently has 13 active refineries and markets its fuels under several brand names, including the widely known Conoco, 76, and of course Phillips 66. The company's shield logo is one of the more widely recognized branding symbols on U.S. highways. The company has been increasing their annual dividend since they went public back in 2012. And currently pay a quarterly dividend of $1.05 per share for a dividend yield of 4.45% with a great payout ratio of under 19%. At the end of May, they reported their Q1 earnings report, where they came out with a solid earnings beat and revenue of over $34 billion. Their next report will be due out on August 2nd, where analysts are anticipating earnings of $3.61. Now, that is fairly close to what they were anticipating back in May, but Phillips 66 came out with a solid earnings beat at $4.21 per share. The company also increased their dividend by 8% and returned $1.3 billion to shareholders. Their stock currently has 10 analyst ratings, coming in as a strong buy based on 8 buys and 2 holds. The average price target comes in at $121 per share, which would be growth potential of 32% from current prices. And we can see a lot of 5-star rated analysts down here, which we love to see as well. Looking at some of the more recent ratings, we have one from 13 days ago with an upside of 44%, and TD Cowen upgraded theirs 25 days ago. They said that the firm believes refining operational improvements should start to be apparent from Q2 with lower turnarounds in the past year. They view refining operational improvements as key to the Phillips 66 investment thesis. And the third stock we're looking at today has the highest dividend yield plus highest upside potential. That is Energy Transfer. Trading under the ticker ET, their stock is priced at just $12.50 per share. Now, they've seen some impressive growth, up 35% this past year and up over 8% in the past few months. Energy Transfer provides natural gas pipeline transportation and transmission services. They own and operate a vast network of pipelines, terminals, and storage facilities across the United States. Their extensive midstream infrastructure allows the partnership to transport and store large volumes of oil, natural gas, and other petroleum products efficiently and reliably. They are one of the largest and most diversified midstream energy companies in North America, with nearly 125,000 miles of pipelines and associated energy infrastructure across 41 states, transporting the oil and gas products that make our lives possible. Energy Transfer started paying their dividend back in 2010, and that dividend was growing consistently up until the pandemic, when they did have to cut it back. But they started increasing it again right away, and it is now back to those pre-pandemic levels. They now pay a quarterly dividend of 31 cents per share for an impressive dividend yield of 8.86%. And we can see down here it was up at that 31 cent back in 2020 and has been climbing back to that ever since. Energy Transfer has established itself as an exceptional dividend stock thanks to its robust business model designed to generate resilient and reliable cash flow. Their revenue streams are supported by long-term contracts with minimum volume commitments, ensuring a predictable and stable source of income. In their latest earnings report at the start of May, they did come out with an earnings miss, falling a few cents short of analyst expectations. And they have done this for a few quarters in a row now, but their revenue did see some year-over-year growth. And also increased their expected adjusted EBITDA for the full year following an acquisition and continued increased demand. They reported adjusted EBITDA for the past quarter of $3.43 billion compared to $3.34 billion from the year prior. Their earnings per share came in at 32 cents, which was 5 cents short of analyst expectations. The next report will be coming up on August 2nd, where analysts are anticipating earnings of 34 cents. But despite that earnings miss, analysts seem to be feeling bullish. The Energy Transfer stock has 8 unanimous buy ratings and an average price target of $17.50, which would be an upside potential of nearly 40% from current prices, so quite a bullish outlook there. The most recent rating came just 3 days ago with an upside of 43%, and one a couple weeks ago went as high as 75% upside, so they're feeling quite optimistic here. So there is a quick overview on 3 dividend-paying stocks, all coming in with strong buy ratings from Wall Street analysts. Let me know your thoughts on these stocks in the comments down below. Which one sparks your interest the most, and what are some of your other favorite dividend growth stocks? I always appreciate hearing from you guys. Keep in mind these videos are never a recommendation to buy or sell any specific stock, just keeping you up to date with what Wall Street is looking at and providing some information and entertainment. Please make sure you always do your own research and due diligence before making any investment decision. If you made it to the end of today's video, hit that thumbs up button and make sure you're subscribed as well. Thanks so much for watching. Have a great day, and I'll see you back here next time.